Welcome to the Vandenack Weaver Truhlsen Legal Visionaries podcast, brought to you by Interactive Legal. Here's your host, Mary Vandenack.
So welcome to today's episode of Vandenack Weaver Truhlsen Legal Visionaries. This is a weekly podcast discussing updated legal news as well as evolving methods of providing legal services. I'm Mary Vandenack, founder and CEO at Vandenack Weaver Truhlsen. I will be your host as we talk to experts from around the country about legal and tax issues, trust and estates, business succession, and exit planning.
Technology has become an essential part of our daily lives. However, not all fields have embraced technology. Lawyers, especially estate planning attorneys, need to stay up to date with specific laws and any issues affecting taxes and wealth preservation. Implementing an automated drafting system can help lawyers spend more time with their clients and less time doing back-office tasks. Estate planners and law professionals turn to Interactive Legal as their main resource for the latest planning strategies. Interactive Legal provides the most comprehensive productivity system on the market, with an easy-to-use document drafting system, extensive continuing education, thought-provoking discussion forums, and more. With Interactive Legal, attorneys get to spend more time with their clients. It's time to connect, collaborate, and create. To learn more about Interactive Legal, visit interactivelegal.com.
Wealth planning focuses on liquidity management and charges you a fee based on a percentage of your assets. But entrepreneurs typically invest in their business, resulting in light liquidity. That requires a unique strategy. At Carson Private Client, we provide a proactive and holistic strategy for building and protecting your wealth. Our mission is to alleviate the stresses and the burdens of coordinating all of those financial strategies. Carson Private Client will work with your current team of advisors to customize a strategy that manages all aspects of your life and wealth, giving you back the time to focus on what matters most. Complex needs require sophisticated solutions. Reach out to our office at 402-779-8989 to schedule your consultation. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor.
Joining me today are Jerry Hesch and Stephen Breitstone. This is our second of two episodes discussing preferred partnership freezes. So if you missed the first episode, you might want to go back and listen to that before listening to this episode 2, because today's episode is basically a continuation of that conversation. In the first episode, we went through what a preferred partnership freeze is, a freeze partnership is, and what some of the advantages of that. And Jerry and Steve are going through some examples and alternatives, explaining in more detail on how that works. So thanks for joining me again today, Jerry and Steve.
All right. Oh, by the way, I have to put a plug in. Steve and I did this paper on preferred partnership freezes last year for the Notre Dame Tax and Estate Planning Institute. And if you want these kind of subjects that integrate income tax planning with estate planning, I highly recommend you consider attending next year's Notre Dame Tax and Estate Planning Institute, which is scheduled in South Bend, Indiana for September 20th to 22nd, 2003. And I have a preference for Notre Dame because I'm the director of it.
And as I understand it, you had a great slate of presentations coming together as always.
Well, we try to give topics that you don't see at other CLE programs, like integrating liabilities into all your planning. Okay. All right. So let's go back to our simple example. And here we have a real estate partnership, okay, with an asset worth $54 million, a basis of 4, debt of 44. So the equity or the capital account is $10 million. And what we want to do in a preferred partnership is have all of those tax attributes that you see on the screen in the preferred interest, but you know that 10% of the capital must be allocated to the common interest. So what we do not do is take 10% of that real estate and recapitalize it as a common interest and 90% of all those tax attributes as a preferred interest. Instead, this is what we do, okay? Senior happens to have $10 million of other assets with a $2 million basis without any liabilities. Now, all that the preferred partnership requires in order for you to have a preferred partnership freeze and allocate everything to any appreciation and excess income to the common interest is the common interest must have 10% of the total capital. So what senior does is has another asset, such as stock in a company, and all we care about is that the other asset happens to have $10 million of basis, $10 million of value. So in this situation, senior contributes this other asset to the partnership for a common interest, and the real estate is the preferred interest. Now notice what I did here, very interesting. The common capital is not the minimum 10%. The common capital represents 50% of the total capital. Now, alternatively, junior or an existing irrevocable trust could make the capital contribution for the common interest. So what happens now is under the partnership income tax rules, under the partnership liability allocation rules and the partnership built-in gain rules, all those obscure technical partnership tax provisions, all of the income tax attributes, inherent net real estate, stay with the preferred interest because everything, all the value and all the liabilities and basis were allocated to the preferred interest. And the partnership income tax rules require that. So now
they're allocated to the preferred interest because preferred interest was received for a contribution of this appreciated encumbered asset. So partnership tax rules, you don't have to be a partnership expert to do this, but just to understand the concept, require you to allocate the pre-contribution gain to the contributing partner, in this case, the preferred interest holder. Yeah. And otherwise, you could just take appreciated property, put it in a partnership, and stick somebody else with your built-in gain. That would be too good to be true.
So even though the preferred interest is 50%, if that real estate is sold for $54 million subject to the liability, all $50 million of the realized gain, which is pre-contribution gain, must be allocated and reported by the preferred partner. So, but remember, we're not going to sell it. He's going to die with the preferred interest. So now, let's see what happens. Suppose a number of years go by, the preferred return is based on senior's $9 million capital account. Okay, the property appreciates in value from 54 to 64 million. The entire appreciation in value is allocated to the common interest. So at senior's death, some years later, all the preferred interest, all the appreciation is in the common, which is now in an irrevocable grantor trust in some estate planning transaction. So at death, the preferred interest is included in senior's gross estate, the entire negative capital account. Now, what is the negative capital account? It is the amount of liabilities in excess of basis. So even though the capital account shows up at a market value of $9 million, for income tax purposes, the capital account is $44 million of liabilities in excess of $4 million basis. So for income tax purposes, the preferred has a $40 million negative capital account. For tax purposes, but for book purposes, it's worth $9 million. Okay. Now, so basically, the problem is the common interest doesn't get any step up in basis at death for that $10 million of appreciation. So we shifted $10 million of value to the common interest with carryover basis. And at slide 33,
Jerry, you might want to just mention, because there is some literature out there that suggests that the common does get a step up in basis on these kinds of scenarios. You might want to mention let's call it the majority view on that.
You mean the minority view that's flawed?
Flawed minority view is that even the common gets a step up in basis, and that we don't think that that's accurate. It's been pretty much repudiated by most commentators, but there are some learned works out there that suggest otherwise.
So I do have a question on that, given I'm very aware of the dispute and was at a meeting last week, has started sitting in the middle of a dispute on that issue. I was like, oh, I think I want to just crawl under the table. But in talking to clients, do you think we at least have to mention that alternative view?
It's flawed. It's absolutely flawed. You have no obligation.
Okay, that's just what I wanted to hear your thoughts on.
Yeah, it's not a gray area, not in my opinion, and not in the opinion of most people these days. Okay. It used to be, but it's really not.
And it's on the Treasury's priority guidance plan. They're going to basically come out one of these years on it.
Well, and, I listened to, so I first ran across Jerry at the NYU Tax Institute in New York, and then you both presented in the fall. And I think one of the things that I've heard the IRS saying is they're going to read what we put out there and use that in terms of their rulings and what they're looking at. And that certainly seems to be the case. So I would certainly exercise
out there.
Okay. They said they read what the commentators write. So I was recently at an ACTEC meeting. So I said, if you oppose this view, please don't write about your opposition to the view, and put those of us who do want to take a certain strategy. And it wasn't actually the grantor trust issue and the basis step up. It was a different issue. But that is something that they do pay attention to what we say and do in terms of the guidance these days.
I would never recommend a client to my client something I know is flawed.
And I think that's a very appropriate statement.
Listen, I've run across scenarios where let's say one of the people who's behind that alternative view would say, why do you need to do a freeze partnership? Everything's going to get to step up regardless. Just sell it to the trust and buy a whole bunch of life insurance. Somehow those two things are not connected, but they're not really connected. And it's a problem when somebody goes out there and promotes a flawed theory.
All right. So now, one of Steve's favorite topics, the leaky freeze. If you have a partnership where 90% of the capital is in the preferred and 10% of the capital is in the common, financially, if the assets don't perform as well, the risk is on the preferred, because there's not much coverage with only 10% of the capital be in the common. So if you go to a qualified appraiser and a business appraiser with a 90-10 partnership capital account allocation, and the preferred return will be in the 9 to 12% range using the 1983 market rate approach. But what we did here is basically have half of the capital in the common. So if there's an underperformance overall on that 20 million of capital, the 20 million still has to be used to first make the priority allocation to the preferred. So a way of reducing the leaky freeze is to reduce the preferred rate of return by having as large an allocation to the common as possible. The only problem is the estate planning community says, oh, all I need is 90-10. So let's have a 90-10 allocation. So if you do a 90-10 allocation, you're going to have a leaky freeze. But if you do an allocation where 40 to 50% of the capital is in the provides coverage by the common, the preferred rate of return or the preferred guaranteed payment will be significantly lower. But they'll still be greater than the AFR or the 75-20 rate. Steve, you have any more comments on that?
I mean, not really.
Okay. All right. So essentially, we like to reduce the leaky freeze by, now, of course, financially, it all depends on the assets that the individual has. Sometimes, remember, most real estate owners basically don't have anything but real estate, because why should they invest in marketable securities that's risky when they know the real estate? So financially, it may not be practical.
You're not suggesting real estate isn't risky.
Yeah. All right.
It's the type of risk that you're comfortable with.
Okay. All right. So now,
but sometimes, just embellish on that, sometimes the senior has a lifestyle that requires the cash flow. And sometimes they want freeze to be bringing back more. They're not always looking to reduce what comes back to them for the preferred interest that they've held. So you have to really know the client. I would say that our wealthy clients and our middle wealthy clients often like getting cash flow back. And the higher the better. If they're ending it all, great. But the really wealthy people typically don't want the cash flow back. They have more than they know what to do with. So that's where this planning really, gets interesting.
Right. So let us review all of the factors that enter into your estate plan. We got our discounts. We got the preferred rate, the financial leverage, which is beating the hurdle rate. And what's interesting is, if you look at all three factors, valuation discounts, that's a one-time thing. The financial leverage is just beating the hurdle rate. But in the long run, the most effective wealth depletion technique is the burn caused by the grantor having to pay the income taxes on the grantor trust income. Because the more value and income is allocated to the common interest, the more taxable income. And if you basically look at a 10, 15, or 20-year time horizon, the most effective estate planning depletion technique is actually the grantor paying the income taxes on the grantor trust income. But you can only...
That also ameliorates this leaky freeze notion. If you're paying tax on all this other income that you're not getting, that tax is going to offset the extra income you're getting back.
Now, here's the key, and this is what I tell my students. You learn this stuff. You learn all the, you learn the acronyms, grits, grats, gruts, Huperts, you name it, and you think you really understand it. So what I tell my students, when you go to visit your grandmother in Boca Raton, Florida, and if you can explain it to your nana or your grandmother and she understands it, then you have developed the communication skills that are necessary for the practice of law. Because way too many estate planning lawyers and tax lawyers speak tax speak, and nobody understands them. So the key is, how can we communicate how all these factors, the financial leverage, the burn, and the discounts all play a role in increasing the wealth depletion and the income tax advantages. So what I've done here is, this is from my class materials, and to keep it simple, no liabilities, because as soon as you get liabilities, it just confuses the facts. So let's suppose senior has $10 million of unencumbered investment assets contributes it to a partnership for a preferred capital account of $6 million and a common capital account of $4 million. And the preferred interest provides for what we call a 6% priority return, which means 6% times the $6 million capital account, or the first $360,000 of partnership income, must be allocated to the preferred, and only income in excess of that priority allocation will be allocated to the common. Now, the common interest has a $4 million capital account, but we can discount it. Let's suppose we take a conservative 25% valuation discount. I also like discounts where the numbers can be even. So 25% valuation discount means that common interest with a $4 million capital account can be sold or disposed of at $3 million. So what senior will then do is sell the common interest to a grantor trust for a $3 million promissory note, taking back the trust promissory note at the long-term AFR. And let's assume that the long-term AFR is 2%. I didn't update this example. So what that means is at a $3 million installment sale, senior is going to get $60,000 of annual interest with all note principal due in 20 years. Now, let's assume for simplicity purposes, senior's income tax rate is 40%. And let's assume that partnership income increases every year by a small amount. Okay. So what this means is, what is senior going to receive every year? Well, he's going to get a $360,000 allocation and distribution from the preferred return and $60,000 from the promissory note interest. So for
the way we do this, by having more of the value of the equity allocated to the common, you're reducing the size of the priority return as well, because there's more coverage.
Yeah, that's why I have a 6% priority return.
Right.
Okay. So basically, senior is frozen at the 360 allocation of profits and the 60,000 of interest income each year. So all senior is going to get for the next 20 years is $420,000. And remember, we just sold that common interest to the grantor trust for a $3 million note. So senior is going to have to pay the income taxes on all of the partnership's income. So let us see what happens. So we have this nice little chart. The first year, partnership income is $500. The preferred allocation is $360. So what that means is all partnership income in excess of the preferred return, $140, is allocated to the common. Senior is receiving $420. But senior has to pay the income taxes on all $500,000, because in this situation, senior sold the common interest to a grantor trust. So there was no sale for income tax purposes. So no interest income is reported and no interest expense deduction is reported. So wait a minute. Look at this. Senior has to pay $200,000 of income taxes. So what does the grantor trust get? Well, the grantor trust basically has 140 common allocation, pays $60,000 of note interest. So the grantor trust at the end of the first year increases by $80,000. And all that senior nets in this situation is $220. Remember, senior got $420, but had to pay 40% of income taxes on $500,000 or $200,000. So, senior says, fine, not bad. So I net $220,000, and my trust increases, even if the assets in the trust don't increase in value, the grantor trust has $80,000 more.
Why isn't it a gift to pay the taxes, for the senior to pay the taxes on the trust income?
Because under the Internal Revenue Code, the statute says that you have an obligation to pay the income taxes on the grantor trust income. And the 2006 revenue ruling said you can't make a gift when you're paying your own debt obligation. That was the reason that the 2006 ruling said you don't have to pay it. That's the advantage of the burn.
It's not a gift, period.
Not a gift. Okay. Now, in year 2, partnership income increases by $100,000. But guess what? All the income in excess of 360 is allocated to the common. So in year 2, the common gets allocated 240. Senior still gets only 420, but now senior has to pay the income taxes on 600,000. Well, so basically that comes to a lot of money. So all of a sudden, after senior pays the income taxes on 600,000, guess what? Senior nets 180, and in the second year, the grantor trust, just on the income allocation, gets another $180,000. And year 3, look what happens. All senior gets is 420. The common allocation in year 4, look at year 4, is 360 to the preferred, 440 to the common. So I have now shifted another 380 of value to the preferred. Senior is paying the income taxes of 40% on 800,000. That's 320,000. Senior nets $100,000. Okay, so senior says, yeah, I really don't need the money. Now look at year 6. Oh my God. The partnership is making $1 million. The preferred allocation is still 360. Senior only gets 60 on the note, but senior has to pay the income taxes on all $1 million or $400,000. And all that senior is getting is 420, so senior only nets 20,000. And all of a sudden, the grantor trust in year 6 increases by another 580. So senior says, all right, not bad. Uh-oh, look what happens in year 7. Income goes to 1.1 million. Senior's still only getting the same 420. Guess what? Gulp, gulp, gulp. Senior has to pay the income taxes on 1.1 million, which is 440,000. Senior only is getting 420. So senior has to come out of that deficit on senior's other assets. The senior says, what happens in year 9 if things keep increasing in value? And I only went out 9 years. But what's going to happen over the next 20 years? The burn is going to be significant. Now, so the next question to deal with is, wait a minute, senior is not happy about having to dip into senior's other assets to pay the shortfall because of having to pay the income taxes on all of the partnership income. Well, one thing that the trust that purchased the common interest can do is start to prepay the $3 million on the note. But that's only a Band-Aid for the next few years. So in this situation, what we're saying is, when you recommend these transactions, you must carry out your financial projections to at least to the senior in their 90s. Because what's going to happen is they're not going to be happy with the burn. You can see every year that, let's suppose that in year 20, partnership income is $2 million. And senior has to pay $800,000 of income taxes. Senior is not going to be happy about that. So one of the things from a financial point of view that you have to structure is how to take into account the burn. And we're not going to get into that. There's things like tax reimbursement clauses or terminating grantor trust status, which is far beyond this. But what we're saying to you...
Yeah, I'd like to make a couple of comments when you're done.
Okay, go ahead.
So most run-of-the-mill planners, let's say, will dismiss this whole thing because they're just too complicated. They don't understand. They'll simply do an installment sale. I've seen this so many times where they'll just do an installment sale of this encumbered real estate, appreciated with built-in gain all over the place, and put it into a grantor trust for the installment note, and turn a blind eye all of the income tax considerations and the loss of basis stuff. I mean, that's too far out in the future for most people to really get their head around it. So that's that's sometimes what we're up against. You have to train them, teach them to understand the income tax consequences of the normal installment sale, which works initially, but over time is a disaster. So that's one point. The other point I want to make, and just as a footnote, is these transactions are not, you don't have to just, you're not one and done. You don't just do them and then walk away and never look at them again. I think you have to monitor them, and you have to look at ways over time, Jerry said he's not going to get into that, fine, of modifying the structure when either the preferred return is too onerous. I had a client, 15 years, couldn't afford to pay the preferred return. Then they finally admitted to me they were paying their preferred return out of savings. It just wasn't enough income in the partnership. I said, why don't you tell me that a lot earlier? And what I did with them is I recapitalized the partnership, which you can do on a tax-free basis, so that there was less preferred return or no preferred return. Turn it all into common at that point. It may be fine because the appreciation has happened, just hasn't had the income to make the preferred return. So there's a lot of things you can do over time, but don't just put it in the drawer and walk away and assume that everything is going to be fine. Like all techniques, you really need to revisit them and be prepared to modify them over time. Jerry just mentioned he's not going to get into tax reimbursement clauses. I'm going to get into it a little bit. It's not something that you usually think of as a way around the burn, but it's pretty standard in partnerships to have a tax reimbursement clause. So we're doing one right now, and we're putting in a tax reimbursement clause. Think about it. And when a typical tax reimbursement clause in a partnership is one that says that you're going to make a distribution to the partners an amount equal to the tax that they would otherwise have to pay, and they may not get enough cash flow to pay it on the operating income of the partnership. So with a tax reimbursement clause, they can get that extra distribution, cover their taxes. It's a way of, it's a standard technique used in partnerships, but not so much in this context. And it's a way of lessening the negative impact of the burn, if that's what you want to do.
Yeah. All right. So what Steve is telling you is we can't do our transactions in isolation. We have to take into account what's going to happen in the future, especially with grantor trust status, and it compounds over a long period of time. And it could be, what can happen is the burn caused by grantor trust status could totally eliminate all of the assets the senior family member has. So maybe one solution is to have the grantor trust be a trust for the benefit of my spouse and my descendants. So if the burn is too great and your spouse is a beneficiary of the grantor trust, distributions can be made to the grantor trust. One problem is, what happens if your spouse predeceases you? You could have a problem. So you must have to integrate the future financial implications of any estate planning transaction that you're doing. Even an outright gift to a grantor trust, you have to show them the impact of the burn.
So I have a question on that. I feel really strongly. I appreciate you making that point, because I do some presenting on ethical issues related to estate planning. And it's really important that clients understand what the burn is, when a trust is irrevocable and they make a gift that they can't really just take it back, those type of things. And I also think really running some of the scenarios is extremely important. And I'm one of those who can build spreadsheets in my sleep. But do you guys use your own spreadsheets? Or for somebody who might not be great at doing that, is there some software that helps them develop the freeze partnership scenarios like this?
Unfortunately, there is no commercial software that takes into account the burn. If you look at Number Cruncher, Zcalc, and some of the other commercial programs, none of them show the impact of the grantor paying the income taxes on the grantor trust income. So, but it's not that difficult to do, or what you do is you get your children or your grandchildren to do the Excel spreadsheet for you. Okay. All right. Now, once we put our preferred partnership in place, the property is going to appreciate in value, and there's going to be future refinancing. So let's go back to our previous example where we basically have a preferred partnership where the common interest was capitalized with 10 million and the preferred interest was capitalized with 10 million. Okay. So, and the common basis, whatever it is kind of irrelevant. So in this is your typical preferred partnership that we structured. And the common interest is now owned by a grantor trust. So what happens if the partnership property increases in value from 54 million to 64 million, a $10 million increase in value? So the 44 million mortgage is refinanced for 50 million, netting the partnership an extra $6 million of cash. Now, what is the partnership going to do with that extra $6 million of cash? Well, what we recommend, although it's not done most of the time, is that the partnership distribute the additional $6 million of cash to the preferred interest as a partial redemption of the preferred's $10 million capital account. Because remember, go back here. Remember, the preferred's capital account was 10 million, and we refinanced it from 44 million to 54 million because it went up. We financed in 44. In other words, we used a 60% loan to value ratio. So if the partnership distributes the additional 6 million of cash from the free financing, we've redeemed a portion of the preferred interest from 10 million to 4 million. So now the preferred interest holder has 6 million of cash, which they're probably going to put into another real estate deal. But look what happens to the preferred priority allocation. It's no longer 6% times 10 million, but is now 6% times 4 million. So the preferred return goes from 600,000 to 240,000. And interestingly enough, if you parcel through the obscure partnership liability income tax rules, who got the economic benefit of that $6 million financing? The preferred. So under the partnership liability allocation rules, the entire $6 million of increase in liabilities must be allocated to the preferred interest. So essentially, in that situation, the preferred interest, now with $4 million of equity, happens to have not $44 million of liabilities, but $50 million of liabilities. So in that situation, we have increased the preferred's negative capital account by another $6 million. And so we have basically had an income tax-free basis step up for the additional $6 million of negative capital account.
Let me make a comment about that. And I know Jerry likes to show these examples in the most simple terms. So
here's the simple example. Under the partnership allocation rules, we now have a preferred capital account of $4 million. All that's exposed to the gross estate is 40% by $4 million. And guess what? We still get a step up in basis at death to $54 million.
Right. But Ed Senior also has the extra cash, $6 million of extra cash in their estate, which they may or may not know what to do with. So this is something that also comes up in the real world and practical world where people are living with a freeze partnership. Normally, they want to make these refinancing distributions to the trust. They're viewing this as profits and upside. They want to give it to the trust. Well, if they give it to the trust, that, first of all, if they give too much refinancing, preferred interest could go down to zero, and that'll trigger all sorts of tax consequences. You don't want to do that. You usually like to give the preferred interest holder a little bit of common so that they're not completely wiped out. Because where do the liabilities go when you make all those distributions? But also, what I have and what I'm dealing with now, we've been doing these for a long time, is a number of freeze partnerships that have been very successful from a financial standpoint, where they've distributed refinancing proceeds to the trust, to the junior equity holders, over a long period of time. And now they have huge negative capital accounts in the trust, which is exactly where you don't want it to be. That's the flaw with the installment sales, is that it all ends up in the trust and there's no step up on that. So we're doing recapitalizations and restructurings of long-standing freeze partnerships to move the liabilities. I'm not going to get into the details of it, but move the liabilities out of the trust and back into the hands of the senior generation that'll hold the preferred.
Yeah. So essentially, I don't think we have much time left. But the point is that in this situation, if we distributed all of the refinancing to the preferred, but senior says, wait a minute, I now have $6 million of cash. Why don't I distribute the $6 million of refinancing to the common that is not included in my gross estate? So we just increased the common's negative capital account by $6 million. Or we reduce the common's capital account, and eventually the common's capital account can go negative with a lot of refinancing. So the next question is, I now have a common interest that's not included in my gross estate with a negative capital account. And, oops, sorry.
And if you run into that scenario, you should call us.
Yeah. The point is, to do this is all, you have to have an encyclopedic understanding of the partnership income tax rules, not only special allocations, but all of the partnership liability allocation rules. And basically, the only people who can really do this have to have a good understanding of partnership income tax rules. Now, who can help the estate planner with the partnership income tax rules. It's the accountants that have to do the partnership income tax returns every year. And they're always a good resource
in this analysis, in this process.
Pardon me?
It's so important to include the accountants in this process. They often get left out. They don't even know you did planning. When you're doing this type of planning, it's especially important to include them in the process. You may have to educate them a little bit about the technique, even some of the partnership tax rules, but they're the ones that are going to be carrying it out, and you really need to include them in the conversation.
I think that's a really important point. Whenever I'm working on really any partnership agreement, I like to bring the accountant in to make sure what I'm doing works and that we're thinking about it the same way. I do want to ask one kind of big question. So in this case, I'm going to make one more comment on the partnership tax. I think, you guys talked about this as an alternate strategy. I think sometimes, like, I took partnership tax and decided to learn it because it was hard. And that was kind of how I built my career, was figuring out anything that was really hard to understand. But if you're not familiar with the partnership tax rules, it could be a deterrent to making this recommendation. And so there's where collaborating with the accountant or someone who really understands them, rather than not using a strategy that might work for the client. But one of the things I do want to ask is this, is in a lot of situations where I'm working with a client, the senior client wants to stay in control for a period of time. And I assume with the freeze partnership, if senior's keeping the preferred interest, that's not a possibility in this scenario.
Not necessarily.
No, senior always keeps the preferred, and the common is non-voting and the preferred is voting.
Or the other way around. I mean, at the end of the day, if the senior is holding the preferred and is voting, I think you're running a risk. I don't know if Jerry agrees with this, of that 2036A2 might apply, so that the senior is in control along with whomever else is, maybe the trustee of the trust. You have to be careful about that. Ideally, would not give the senior control or even a voting right over the partnership, not directly, maybe indirectly. There's various things you could do, but there's another school of thought. I speak a little bit for Jerry, that if you comply 100% with Section 2701 in every regard, that's a safe harbor. And there's nothing in Section 2701 that says you cannot have some voting rights as the senior. It doesn't say that. And there's never been a case or a ruling on this point.
So that's a possibility. And so then my other question was this is obviously a great strategy for the leveraged real estate investor. And these are really common scenarios. Is there another type of scenario that this is a great fit for?
I think that's where it's most valuable. But we've been brought in to do these for people that have marketable securities. And depending upon let's call it the risk profile, the income profile, likelihood of appreciation. I did a technique like this, for example, for one of my clients. It wasn't leveraged real estate, but it was real estate where it was, worth, let's say, $40 million. And we put it into a freeze partnership. And then he sold it about a year or two later to a big development firm for like $100 million. It worked amazingly well for that client. And they've parlayed that, they're not, into like $400 million. So it can be used with other assets, but you have to look at likelihood of appreciation.
Actually, if I have a $10 million capital account in my partnership and I want to sell it to a grantor trust for a $10 million note, that means I got to have a $10 million note. And then there's people who believe in the 10% minimum funding myth. So they say, if you're going to have a $10 million note, the trust has to have $1 million of seed money. So if you do the preferred partnership, remember the grantor sale or grantor trust is nothing more than a freeze, because you're replacing the one asset with a promissory note that doesn't appreciate in value. So if I take the 10 million, make it 9 million preferred and 10 million common, then all I have to do is sell the $10 million common interest to the grantor trust. And if they want 10% minimum funding, all that the seed money for the grantor trust is 100,000, not $1 million. So it's a way of reducing the cost of the freeze transaction by not having to have the grantor trust with more than a small amount of capital.
We leverage these. Again, it's leverage upon leverage. Most of these freeze partnerships turn out to be a combination of a freeze partnership and an installment sale. We structure it so that the leverage, the liabilities are not allocated to the common interest; they're allocated to the preferred interest, and then we sell the common interest for an AFR loan, and that can help in a number of ways. You don't get a step up on that piece, but the AFR loan bears interest in the AFR, right? So if a significant portion of the equity is being sold in the form of the common interest, then you're getting the benefits of the installment sale, but you're still structure it so that the preferred interest can still have all the liabilities allocated, even though it might have a small slice of equity. There's a balancing these. You don't have to put any more equity in that preferred interest than is necessary. And sometimes when there's a lot of leverage involved and a low return, we'll structure it so that preferred interest doesn't have a lot of equity, but it gets all the debt allocated to it. And then you can sell the equity, the remaining equity for an AFR loan. So you get the best of all possible.
At the end of the day, this is a strategy that ought to be in the estate planner's toolbox that might be overlooked in terms of value for certain types of, particularly the leveraged real estate or real estate investor, but also other options might be overlooked because of the complexity. But the answer to that is partner with the accountant and consider this strategy. And I really appreciate you guys spending the time sharing on this. And I did want to mention one other thing, because Steve, you mentioned Jerry's statement about a safe harbor is just a safe harbor. And I just wanted to share with you, Jerry, how many times I've repeated that to my associates since I attended your presentation where you made that statement, because a lot of people will look at a safe harbor and think that's the rule, when it is truly just a safe harbor. And you don't have to totally follow that if you're really clear about what you're structuring. Would either of you have any last thoughts today?
I just think that it's malpractice to take your leveraged real estate owner with a lot of built-in gain appreciation and not use this technique. I feel very strongly about that.
As a matter of fact, there was a law firm that took $1 billion of real estate that was encumbered, and they did an installment sale of the real estate, regular common partnership interest, installment sale to a grantor trust. And then the financial advisors said, hey, you're not going to get a step up in basis at death for all that negative capital account. So they sued the law firm for malpractice.
Yep. So the importance is be familiar with all the tools. It's one of my things in talking with associates that I say, don't get stuck on one tool. Really be an objective-based planner. Understand all the tools that are out there. You may not be an expert in everything, but one of the best things you can do is have a network that finds experts like the two of you, who hopefully you would be willing to take a call from a listener if they needed some help with the strategy. But thanks again for participating today. As we reach the end of our episode, I want to thank our sponsors. That's all for now. Thanks for listening to today's episode, and stay tuned for our weekly releases.
Vandenack Weaver Truhlsen Legal Visionaries is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Vandenack Weaver Truhlsen Legal Visionaries podcast does not create an attorney-client relationship between you and the firm or any of its attorneys. The Vandenack Weaver Truhlsen Legal Visionaries podcast should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.